Welcome to today's Explainer. It's May 29, 2026, and the market is officially pivoting. Coming hot off the closing energy of Consensus Miami, we're zooming out. We are looking way past the daily surface noise to understand the massive structural shifts that are, right now, actively rewriting the rules of the global financial system. We're going to map out exactly how sovereign realignments, the complex policing of stablecoins, and the absolute deep plumbing of crypto are setting the stage for what comes next.
Okay, let's dive into this. $78,348. That is a massive number. Bitcoin's price has surged right past 78,000. Now, while this is what's capturing literally all the mainstream headlines today, I really want you to think of this price action as just the highly visible tip of a much, much deeper iceberg. To actually understand what's fueling this run, we first have to look at the macro geopolitical factors, and then we're going to descend layer by layer right into the underlying mechanics of the market.
Section 1, the macro relief rally. Let's look at what's driving the immediate surface-level action. So the major catalyst today is a massive global relief rally following Iran reopening the Strait of Hormuz right on the heels of the Israel-Lebanon ceasefire. What the market is doing right now is rapidly digesting the removal of that war risk premium. With the geopolitical chaos momentarily dialing back, the fundamental utility of trustless, borderless payments is being thrust right back to the absolute forefront of institutional focus. But hey, it's not just geopolitical relief driving this, right? Take a look at CoinZoom's recent announcement, record deposits and trading revenue for Q1. This is actually fascinating because we're currently in what a lot of people are calling a viewership crisis in crypto media. Retail social engagement is remarkably low right now, yet despite that quiet timeline, actual user acquisition and quiet retail fund flows are hitting all-time highs. The money is absolutely moving. Section 2, the stablecoin intervention war. Let's take our submarine just below the surface here. $280 million? That staggering number is the amount lost in the recent Drift protocol exploit. And this massive hack, it has completely ignited a deep, industry-wide philosophical divide over exactly who gets to police your digital money and how they should be allowed to do it. The chronological fallout here has been incredibly rapid. Step 1, the $280 million exploit hits. Step 2, Tether immediately steps in with a $127.5 million rescue plan. And Step 3, a class action lawsuit is filed against Circle regarding their response to the hacked funds bridging right through their ecosystem. By moving so aggressively with this rescue plan, Tether basically used the crisis to directly challenge Circle's grip on Solana payments. Now, what's really interesting about this is the stark contrast in governance philosophies that's emerging. And just to be totally clear, we are strictly looking at the mechanics of this divide neutrally, without taking any sides. On one hand, you have Circle arguing that freezing funds absolutely must follow a strict, lawful process. But on the flip side, following the Drift and RWA exploits, Tether is actively out there proving the massive market appeal of fast intervention to just stop bad actors in their tracks. So why does this matter so much? Listen to this quote from the coverage. After Drift and RWA, stablecoin users may care more about stopping thieves than old crypto slogans. Security is rapidly becoming the absolute top priority for major capital allocators. It's forcing every single user and institution to make a really hard, practical choice between absolute censorship resistance and immediate financial security. Section 3, the real-world asset breakout. We're plunging even deeper into the plumbing here. CoinGecko's highly anticipated 2026 RWA report just went live, and it confirms that specialized infrastructure tokens are completely exploding. We are moving decisively beyond simple retail speculation. Case in point, Flow Capital just announced plans to tokenize its $150 million private credit fund via the DigiFT platform. But there's an expert warning we need to mention here. Tokenization alone doesn't magically create secondary markets. The underlying infrastructure has to catch up to handle these massive flows. And the numbers totally back this up. Look at these 30-day surges. Dusk Network is up over 92%. Centrifuge up over 63%. And over in the DeFi sector, we're seeing advanced peer-to-peer lending layers like Morpho up almost 12%, alongside others like Pendle surging as well. This proves that institutional capital is aggressively rotating into specialized yield protocols built specifically for tokenizing private debt. They aren't waiting, they're pricing in these flows today. Section 4, shifting sovereign gravity. Let's descend to the absolute ocean floor of our iceberg model. So the crucial point to grasp here is the concept of deposit tokens. These are digital tokens issued by banks that represent actual deposits, and the Bank of Korea is now officially testing them for government spending. Think about that for a second. This is a monumental move completely away from your standard retail crypto trading, right into the foundational bedrock of national finance.
What you should absolutely take away from this is the structural reality. This pilot program marks a major escalation in the use of public blockchain rails for national fiscal operations. It signals a definitive shift toward fully programmable government budgets in Asia. They're not just studying the theory anymore, they're actively building the rails.
Section 5. Washington's regulatory gridlock. Now let's contrast Asia's structural momentum with the friction back west. Just impartially laying out the facts of the legislative hurdles currently straining the Clarity Act, there's a serious legal shadow forming as Senator Elizabeth Warren has formally accused SEC Chair Paul Atkins of perjury, essentially lying to Congress regarding the agency's enforcement decline. This severe political friction, along with Senator Tillis delaying the stablecoin yield draft and ongoing ethics debates in the Senate Banking Committee, is completely paralyzing the regulatory landscape across party lines. And the market consequence of this gridlock? Well, it's pretty severe. JP Morgan is actively flagging major political risks that analysts warn could delay U.S. stablecoin certainty all the way into the 2030s. If U.S. regulation remains totally paralyzed by this Warren-Atkins political feud, the center of gravity for programmable finance will inevitably and decisively shift to the east. Section 6. The structural supply squeeze. Let's bring all these deep layers of the iceberg together for our market outlook.
And this brilliantly illustrates where we stand today. We've got massive sovereign realignments in Asia, explosive institutional volume in real-world assets, and huge tether-governed liquidity flows rushing toward security. Combine all of that with the fact that exchange supply is hitting decadal lows thanks to record whale buying. The stage is perfectly set for a structural supply squeeze that could literally shatter the Fed's ceiling, entirely regardless of whatever gridlock is happening in Washington.
Which brings us to the ultimate question I want to leave you with. As institutional capital votes with its massive wallets in this totally new frontier of programmable money, what do you value more? Absolute censorship resistance or immediate financial security? It is undeniably the defining philosophical battle of this cycle. Keep your eyes on those RWA volumes and stablecoin liquidity flows. Thanks so much for joining me for this explainer, and I'll catch you next time.